How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. I hope everyone is having a wonderful weekend so far. This is my kind of second episode, if you will, in covering basically what's going on with the Chinese and Japanese mega banks. So if you just checked out the previous episode that I just did, we kind of did an update on Chinese real estate and kind of how that's affecting their banks over there and why that's important for the U.S. market and the U.S. government and U.S. investors and why we all need to kind of keep an eye on what's happening there. Now, in this episode, I want to delve into a little bit about what are some of the actions being taken by the mega banks over there in Japan and China as they both are continuing to deal with very different issues. So let's jump into this real quick here. So Chinese megabanks to adopt semi-annual dividends, keeping payout rates steady. So Chinese megabanks will likely shift to half-yearly dividend payments following a regulatory push, though payout rates may remain stable over the next 5 years. Industrial and Commercial Bank of China, the world's largest lender by assets, is projected to maintain its 2024 dividend per share at 31 Chinese yuan, unchanged from 2023. According to estimates by S&P Global Visible Alpha, Bank of China is also expected to keep its payout at 24 yuan, with Agricultural Bank of China and China Construction Bank Corp projected to distribute 23 yuan and 40 yuan, all unchanged from 2023, again, based on Visible Alpha consensus estimates from at least 3 analysts. But most major lenders received shareholder approval to implement twice yearly dividend payments following December 23 guidance from the China Securities Regulatory Commission. The regulator also simplified the dividend approval process to help companies adapt to the increased payment frequency. So dividends, so we can see here dividends per share at the Chinese 4 largest banks. You can see here, estimate actual and then estimated. Just down here below it. So for 2023, we have actual, and then 24, 25, and 26, we have estimated. And you can see here kind of, estimated, then 26, a little bit of a tick up. Second bank here, a little bit of tick up, 25, 26. Again, a little bit, so they're all seeing just a tiny little 1 cent, tick up here as we kind of come down. Their long-term dividend plans were in response to CSRC's call for multiple dividends in the hope of delivering more stable share price movement and encouraging long-term investment, said Chris Tan, a senior equity analyst at Morningstar. Despite the increase in payment frequency, payout ratios at the big 4 banks will remain unchanged at 30%. The 4 state-owned mega banks are operating in a challenging environment as they support the national goal of 5% GDP growth in 2024. The world's second largest economy grew 5% in the first half, following 5.2% growth in 2023. But economists warn of challenges ahead, including a downturn in the housing market and a clouded export outlook due to an expected global economic slowdown. It will become standard practice for major banks to pay dividends semi-annually if their financial performance is solid. Most banks will remain a 30% payout. So again, just kind of interesting to keep an eye on here. I mean, they're trying, as if you saw the last episode, I reported on basically, this slowdown, these big problems in the real estate market there in China has really hampered banks. They're really trying to reduce their real estate exposure. At the same time, the government is trying to put all these incentives out there. They reduced the interest rates. They gave a bunch of perks, for people, for first-time home buyers. They're trying to do a lot of stuff to stimulate their economy right now, and obviously they're trying to stimulate they keep the return, banks' returns over there. They're trying to prop everything up basically at the moment, in terms of trying to keep, like I said, and if you watch the last episode, I talked about China's GDP, about how, 5% or below GDP growth for them stinks. Like that would be if we had like a negative 1% GDP, that would be horrible GDP for us. Well, 5% for them is kind of the net effect, because they're used to having double digit GDP, like, 10, 11, 12% growth. So for them to only have 5% growth in this massive growth economy is a big issue. So All right, let's take a look about so what is going on with Japan right now? So surging yen threatens megabanks' currency gains amid diverging U.S. Japan policies. So, currency gains for Japan's three megabanks are expected to diminish as the yen's recent appreciation against the dollar is likely to accelerate due to diverging monetary policies in the U.S. and Japan. So, Mitsubishi, I'm just going to say MUFG, Sumitomo, Futsi. I'm just going to say SMFG, and Mitsu Financial Group benefited earlier in 2024 from the yen's decline, which boosted the value of their overseas earnings when converted to yen. This effect contributed to strong net income growth in the fiscal first quarter ended June 30th. But with the yen recovering about 8% from a 4-decade low, these gains are expected to diminish. So as the mega banks have much exposure to overseas markets, the dollar yen rate would have a sizable impact on their profits, said Hideo Oshima, a senior economist at Japan Research Institute. Any weakness in the U.S. economy would prompt the Federal Reserve to cut interest rates, leading to a stronger yen and reduced margins for Japanese banks. And then we get into how the policies are diverging. So the Fed is widely expected to cut rates at its September 18th policy meeting after a series of subdued economic reports raised concerns about a slowdown in the world's largest economy. The move would contrast with the Bank of Japan, their second rate hike of the year in late July, with more increases anticipated as the Japanese central bank normalizes its monetary policy. Japan's megabanks have expanded into overseas markets, primarily in the U.S. and Asia, to strengthen their investment banking and financing businesses. The strategy was driven by the Bank of Japan's 8-year negative interest rate policy, which pressured domestic margins. While the banks do not disclose regional profit breakdowns, about 40% of their outstanding loans were from outside Japan in the fiscal first quarter that began April 1st. So that's huge. 40% of their outstanding loans. Now, I want everybody to keep in mind that Japan ended their negative interest rate policy, which was they were the last country to do that. Kind of Europe got out of it and a couple other countries around the world got out of it. Japan was the last bank to get out of it. Now, they just took their rate positive by a meager 25 basis points. And we saw the effect that happened. We saw the blow up of what's called the carry trade, the Japanese carry trade, basically blew up. And recent reports indicate that carry trade is not even close to unwinding. Now, one of my questions here is that the Bank of Japan did come out and basically said that they were not going to do any more rate hikes, which may have stabilized the potential losses or the decline in their economy for the moment. But the reason why they were raising rates was because they were trying to contend with the strengthening yen. They wanted to try to weaken the yen. That's why they were raising the rates. If they can't raise the rates, because that'll blow up the carry trade, which will then blow up their economy, because they've got all this money invested in the U.S. markets and 40% of their loans are also in the markets. That's a major problem for them. It's a major problem for them. And then let's see if so basically hawkish Bank of Japan, the Bank of Japan's hawkish stance may drive the yen higher, contrasting sharply with the U.S., where the first rate cuts since the early pandemic are anticipated, with inflation nearing the 2% target and labor markets softening. The Fed is likely to ease rates. Yes, they probably will start decreasing interest rates in September. The correction of the yen's weakness won't be temporary. We see little currency risk unless the yen strengthens beyond the yen 140 level, said Takayuki Hara, head of MUFG's corporate planning division, during an August 1st online briefing following the bank's first quarter earnings release. In an August 5th report, UBS projected the yen would appreciate to Y140 per dollar by mid-2025, down from Y147 per dollar in September. The Swiss bank's forecast is based on expectations that the Fed would cut rates by 100 basis points by the end of 2024, revising its previous prediction of 50 basis points cut. So that brings another interesting thing. I mean, Wall Street is expecting now for the Fed to basically go nuts with interest rate cuts here before the end of the year. I do not really see that happening. I mean, I see a quarter point cut in September. Um, Maybe we get another quarter point cut. I mean, I think that their original prediction of 50 basis point reduction probably still holds true. But I mean, unless something happens, like I don't know, the BLS coming back again and saying that more job numbers were false, or retail sales numbers were false, or the GDP numbers are false, or yeah, pretty much everything's false. Um, so now remember the BLS just had that major revision. They're going to be coming back in January with another revision. That's going to be another downward revision. So it's going to get even worse. So my prediction is still that the Fed holds steady. They do a 25 basis point rate cut in September, and then they sit back for a few months and see what happens. And remember, they do not have a meeting in October, and then they have a meeting at the beginning of November, and then they have a meeting at the kind of like the middle of December. So after the September meeting, they only got 2 more meetings for the rest of the year. So we will see. Again, if this 100 basis point prediction comes out, you're talking about probably 50 basis points in September, and then another quarter in November, another quarter in December. And I'm not sure if I really see that happening right now, or if I see the Fed moving that aggressively. Right now, what I see is quarter point in September, and then you're going to get more crappy economic data throughout the rest of the year, and you're going to get more revisions to the downward side. And then that will prompt the Fed to really start getting more aggressive early next year with a continuous, quarter point rate declines, January, February, March, April, just cutting quarter, until I think they get down probably about 100 to 150 basis points is probably where they want to be. And then kind of see, how that stimulates the economy. But getting back to this for a second, I mean, this is not, necessarily going to help the Bank of Japan here. So let's get to the final article here. So mainline Chinese, Japanese banks fuel July debt issuance volumes. So the Asia Pacific banks' aggregate debt issuance volumes rose more than 60% year over year in July, driven by multi-billion-dollar offerings from mainland Chinese and Japanese banks. The region's banks raised an aggregate $20.43 billion via debt securities in July, compared with $12.67 billion a year ago. The July total, however, was down from $32.93 billion in the prior month, driven by mainland Chinese and Australian banks seeking to strengthen their capital. Mainland Chinese and Japanese banks accounted for more than 60% of the capital raised in July. Mainland Chinese banks, especially those that are state-owned, are likely to stay active in the capital markets, Iris Tan, senior equity analyst for Morningstar, said in an email. So state-owned banks obtained regulatory approvals for issuance of Tier 2 capital bonds and perpetual bonds in 2023. As of mid-2024, there are still 1.4 trillion won of new issuance quota unused. As banks enter maturity peak in the third quarter, I expect the trend will continue. Tan also said that banks' rapid asset expansion during the pandemic period and weakening profitability are some of the reasons behind increased needs for capital replenishment. So then growing debt issuance volumes, equity offerings, and then Chinese Asian bank, the capital raises there. So basically, basically the Chinese and the Japanese banks are basically trying to raise capital. They're trying to get capital in, especially the Chinese banks, because they need it to basically offset the losses that they're having from a lot of the commercial real estate and stuff that they have on their books. So, so what are some of our big takeaways on this? So basically, the Chinese and Japanese markets are both have different issues going on, and are both going to continue to basically struggle here in the short term for different reasons. I think that the numbers coming out of China are somewhat suspect. I think their numbers could be actually a lot worse than what they're reporting. So that's something to kind of keep in mind. And I think that, that the Japanese carry trade is something to be, kind of very concerned with over the short term because of if the depending on how aggressive the Federal Reserve is in cutting interest rates. I mean, that divergence in policies between their central bank and our central bank, and what that could mean to the continued blow up of the carried interest trade, and the fact that Japan's got over 40% of their loans invested in overseas markets, probably mostly here in the U.S. These are all issues that are going to continue to linger into the future and are continue to be a problem. And we'll just have to see how they play out. So, but if you did not get a chance to check out my previous episode on basically the Chinese real estate market, check that out, because these two episodes kind of go together in reporting on these problems or these issues. So please make sure to check that out. And if you did not see my live streams from Friday on either Podbean or on YouTube, please go check those live streams out for basically the weekly banking update in the strategy room. And check out some of the other content that I have on the channel. But I will wrap up with if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below, and I will see everybody again. Have a wonderful weekend, and I will see everybody again next week. Thanks a lot.